I think today's topic is pretty topical today. And I think if we look at, the past 2 decades, we clearly have moved, forwards and backwards in many ways. After the Great Depression of the 30s, Glass-Steagall's Act, came into, existence. And of course, there was a clear distinction between what banks could do and what banks could not do. And I think what we did, we saw also in the rest of the economies, whether it is the West, or we saw the dismantling of the communist wall in Germany, communism in Russia, that there was a move towards market-based economy. I think in particular, the emphasis was on market-based economy and self-regulation. It started off in the United States, and it obviously was being replicated not only in Europe but also in the rest of the world. Virtually, I think there was very little regulations, and I think when you talk about the banking sector and the financial sector, there was very little and limited understanding of very, very complex investment products. There was heavy reliance on rating agencies, and of course the credibility of these rating agencies, came to almost naught, when the crisis came, because there were also, lack of checks and balances. I think if we also look at the euro currency, the introduction of the euro currency and the gradual expansion of the eurozone, it was associated with these kind of regulatory challenges. More importantly, I think we saw during the last 20 years, the shift away from the concentration of the 3 zones: US, Euro, Japan, and I think the world was moving more towards some kind of a balance as what you call the BRICS and some of the other emerging economies of Asia and Latin America. They became important, so you could see there was a balance away from just concentration, from these economies, and more towards a balanced economy. We also saw in these 2 decades, that there were some unsustainable, lending practices. I think if you saw, if we just track, back, since early 90s, there was a growth period, but growth period more based on not savings, growth based on easy credit. And I think, easy credit and I would say lax credit. And you could just hear products like low doc, no doc kind of policies in the lending institutions, in the US, in Europe, and even in some parts of Asia. There was unbridled growth of securitization of real estate and other assets. And obviously, as I mentioned earlier, that the complex derivatives which are derived out of these basic kind of products, the CDOs and many others. At one stage, people didn't even know how much of the derivative risk the world was carrying, and I think this is what created a kind of a risk factor. Now, added to that was a very volatile oil and commodity kind of market. As you know, that the oil prices started moving up, peaked sometime in September 2008. The commodity prices also fluctuated rather viciously, and that meant that the inflation also started rising in some countries. Of course, we all know that what happened. And once the bubble burst, because once people realized some of these assets which they were carrying did not have the kind of value which rating agencies had given ratings to, and then there was a collapse. And when, investment banks, which obviously, were, had been acquired, and so, some of these, banks had been acquired by commercial banks. So there were no Chinese wall almost, between the people who arranged, manufactured these products and people who were actually selling these products. And how could, one have, kind of Chinese walls, or rather you could enforce those Chinese walls when Solomon Smith Barney would just manufacture a product and would be distributed through Citibank, branches. I mean, when obviously the compensation would, and the bonuses dependent on, the incomes from these products. I mean, how would you just say that there will be, effective Chinese wall? So what happened was that, some of these investment banks, traded, very thinly on their capitals, and when Lehman came down, we know that the gearing ratio was almost 40:1, which means their capital was no more than 2.5% of the assets. So we saw banking sector in a disarray, huge losses, very limited appetite, obviously for credit, because they did not have liquidity, jobs, and when that happened, and of course the economic recession, just came in, people lost jobs, there was obviously a collapse in the housing sector, and there were no takers over there, and of course because of that, the equity of a lot of people who basically had leveraged their, the homes, and they just took equity out of them. When they saw that going away, obviously appetite to just buy cars and other consumer items just fell, because they also lost their jobs. So we could see, we saw a sharp decline in international trade, which shrunk in 2008, and of course barely came back in 2009. We also saw continued volatility in the energy prices. They went up and then they came down. And the impact on the stock exchange all around the world. I mean, we all know what happened not only, in Pakistan, but also the rest of the world. And although there was a negative growth in the developed markets, last year, because of some of the emerging market countries like China, India, and few others, I think the world did grow, but barely at 1.3%, the lowest since 1982. Now, what did the governments do? The governments, they did what they were required to do. They went into emergency intervention in most of the countries, and I think they just started supporting the financial, markets, financial institutions. I think they did make a mistake, obviously with Lehman, because that obviously they never expected the fallout to be that severe. But thereafter they went into safe banks like Citibank, Bank of America, insurance companies like AIG, and in Europe, Northern Rock and Lloyds and RBS and you name it. So I think they just went in with emergency intervention, and virtually I think we saw the government going back. This was a reversal of many decades of move towards market, moves towards self-regulation, move towards private sector taking ownership of these enterprises and businesses, and I think we saw government going back, taking majority in some of these financial institutions. Unheard of, unthinkable, but it happened. Aggressive monetary policy, rates were reduced, although there was some danger of inflation, but given that inflationary kind of fears were really not that great, that they just eased the inflation, the monetary policies by reducing kind of interest rates in Europe, in US, and of course parts of Asia. And then you could see aggressive, fiscal stimuluses. I mean, both in the US and in Europe.